The market, as far as I can see it, is engaged in hyperbolic discounting, and that is a sure route to losses.
Welcome to another Breakout with Breakingviews, brought to you by PGIM. I'm here with Edward Chancellor, who's written a sassy column on tech stocks and why investors really need to look out given the valuations today. Eddie, let's talk a little bit about this tech bubbles. We've seen them before. We've all seen stock market bubbles around technology, not the one we think about. We think of railways or canals. Give us a little sense of the historical precedence here.
The way I see it is that when you've had a successful new technology establish itself and deliver very good returns, then investors get excited and seek to sort of transpose those returns onto a new generation businesses. Now, you mentioned the canal mania in the late 18th century in England. That started after the great success of the Bridgewater Canal that opened in 1760. Then you have in the 19th century the British Railway mania, again a mania in railways in the 1840s after the success of the first generation of railways. Now think back to the internet bubble in the late 1990s. Everyone, if you remember at the time, was looking for the next Microsoft, and we're sort of really back to that mentality today. Over the last 20 years, the likes of Amazon and Google and Apple have delivered fantastically good returns. And then more recently, you've got Facebook and Tesla compounding annually at 30% and 60% since their IPOs. So what investors are doing is thinking this is the sort of growth that is possible, and they're pricing in that growth in a whole slew of new companies today.
Well, of course, I mean, if you look at, everyone wants to find the next Facebook, everyone wants to find the new Amazon, but the valuations today reflect the idea that they've already found it to some degree, right? They're pricing in that success. Is that completely wrong? I mean, I think of it almost like venture capital. If I've invested in 10 and one turns to be, the next Amazon, I probably did fine, right?
Yes, you could think of it like that. I mean, so I would say that the sort of epicenter of the tech bubble at the moment is in the so-called cloud-based businesses, software as a service sector. Now that sector, which has companies ranging from Adobe, the PDF provider, to Zoom, which we're currently talking on, the stocks the stocks in that sector trade on 28 times forward sales. Now that is a massive sales multiple.
Wait, you said sales, not earnings. Just to
not earnings. A lot of the
markets valued at 20 to 25 times earnings in a crazy market. We're talking 28 times sales, way up above.
We used to think 28 times sales was earnings was expensive. Now 28 times sales is like, hey, it's a bargain. And the problem with that is that in order to justify that valuation, you're going to have to compound your current sales at a very high rate over 10-year periods. So let's say a 30-year compound annual growth in sales over 10 years. Now, a study by Michael Mauboussin, who used to be at Credit Suisse, shows that just 1 in 300 companies has ever compounded their sales at that rate. So if it was sort of 1 in 10, then perhaps this would be worth a bet. But 1 in 300, you are really taking the odds are very much stacked against you. As I mentioned the piece, Ben Inker, my former boss at GMO, has calculated and written in a recent note that companies selling on 10 times sales have historically delivered half the return of the S&P 500 since 1980. So whereas the S&P's delivered north of 8% real, companies trading on 10 times sales actually have only delivered 4% real. Now, if you think if you're buying software companies at 3 times that level, I reckon you'd be lucky to get your money back at some stage in the future. Yeah, there will be a few winners there, but the losers will be far greater.
And is this just a case of people getting overexcited about the technology, or is there something else about money flows and discount rates and things that we should think about that's driving this?
Yes, I think so. I mean, I think partly it's just an excitement of new technologies and the scalability and the high margins for software companies. We all understand that. But the other factor, and I think very important factor, is that with interest rates at very low levels, people are, as they say in the 1920s, they're discounting the future and the hereafter. There is no, the sales of these companies out at 10 years' time are given a sort of full value today, as if the passage of time and as if the risk of actually fulfilling on your strategy is not there at all. And I think, therefore, time is completely mispriced. And we talk about something called hyperbolic discounting, where speculators apply a lower discount rate to returns out in the distant future that are very uncertain to more certain returns today. And so the market, as far as I can see it, is engaged in hyperbolic discounting, and that is a sure route to losses.
All right. Well, thank you, Eddie. And we'll be back with another breakout from Breakingviews soon.
Thank you.